It's a critical time for the US economy, and it might be heading towards a crash. And that's a big deal. And guess what? Janet Yellen, an experienced economist and former chair of the Federal Reserve, recently admitted something important during her talk with Congress. She warned that cutting ties with China would be really bad. Right now, the US is trying hard to stop China from selling off more of its US Treasury bonds. China's gradual reduction of US Treasury bond holdings is a serious concern. They used to hold over $1 trillion, but now only have $859 billion left after almost a year of selling, which is basically worrisome. What if they refuse to cooperate or play by our rules? Congress conducted a simulation exercise to assess the potential impact of sanctions against China and a possible Taiwan invasion. The major concern is that China's substantial ownership of US Treasury bonds could lead to a rapid sell-off, causing significant problems. Timing is critical, and the current situation is complex. Normally, selling their bonds would harm China's own economy more. We're facing two major challenges. Firstly, dollarization is increasing, with more countries adopting the US dollar. Secondly, we must manage high interest rates without triggering an economic crash. China's retention of US Treasury bonds is a reflection of its historical practice. Since joining the World Trade Organization in 2001, they have purchased US dollars from their exporters to keep the value of their currency, the Chinese yuan, low. This enables them to sell goods at competitive prices. Instead of holding onto the money, they invest it in US Treasury bonds for interest. This arrangement has been practical because retaining the money would lead to devaluation. However, this dynamic is now undergoing a shift. China has been slowly selling some of its US Treasury bonds, and that's worrying Congress. They told Janet Yellen, a top economist, to get ready for what might happen. In normal times, if China sold all its bonds, it wouldn't have a big impact. The US Treasury market is really big, and there aren't many other options for investing money. It's worth over $25 trillion, which is as much as the combined bond markets of the G7 countries plus China. So, if China sold their bonds a couple of years ago, it would have caused chaos, but the world could handle it. But things are different now. The United States has been raising interest rates quickly, and we have a huge amount of national debt. This makes the economy very vulnerable to a sudden sell-off of Chinese bonds. In just 12 months, interest rates went from 0 to over 5%, which is a big increase. It's really concerning and could push the economy to the edge of a collapse. Now let's talk about what could happen if China sells off its treasuries. While some people on Twitter mention that China's holdings are only 2.8% of the US debt, there's more to worry about than just the numbers. The real concern is the potential for liquidity problems if China starts selling, which could lead to more selling by others. Hong Kong, part of China, holds $230 billion in treasuries, while China as a whole controls over $1 trillion worth. Given our fragile economy is heavily reliant on borrowing, this poses a major risk. A single misstep could cause our economy, built on a precarious foundation, to collapse like a house of cards. The global economic outlook is also worrisome. Germany is contracting, the EU is in recession, and even New Zealand fell into recession after raising rates to a 14-year high. This scenario is precisely what the Federal Reserve fears. They aim to delicately balance the situation, seeking a smooth landing while combating inflation. In June, the Federal Reserve chose to pause rate hikes instead of continuing to raise them. Although the Consumer Price Index, or CPI, indicates a drop in inflation from last year's peak of 9% to 4%, we should not be deceived by this figure. Inflation remains a significant problem. Core inflation, currently at 5.3%, surpasses current interest rates, indicating the need for the Federal Reserve to either raise or at least maintain rates for the time being. Let's talk about China possibly selling a lot of the money it has lent to the United States. This could be a problem, because if China sells all those loans at once, it could hurt the American economy. China has been lending money to the United States by buying its bonds, but if they sell those bonds, it means they're no longer supporting the United States financially. However, China would also lose a lot of money if it sells the bonds now, because interest rates have gone up. This means they would be selling the bonds at a time when they're worth less, so they would lose money. The selling of bonds could have significant implications for the fragile US economy. A sudden increase in interest rates could trigger another banking crisis, as evidenced by the recent collapse of 3 US banks due to rising rates. Banks hold a substantial amount of long-term bonds and securities. And when interest rates rise, the value of these assets decreases, leading to potential losses if sold. The decline in the value of long-term bonds has a ripple effect on other bank assets. The collapse of Silicon Valley Bank serves as an example of the consequences when a bank heavily relies on these longer-term bonds. The bank was unable to meet its debts when the value of these bonds plummeted following interest rate hikes by the Federal Reserve. It's important to note that other banks like Wells Fargo and State Street also have a lot of these bonds. If China sells its US bonds, it would cause bond prices to crash and interest rates to rise. This would put more pressure on the financial system. Now, let's see how big of an impact it would be if China sells a lot of its US bonds. According to the Federal Reserve's calculations, if China sells around $1.2 trillion worth of bonds, it could cause interest rates to go up by 30 to 60 basis points. This means that the interest rate for a 10-year US Treasury bond could go up by 25 to 50 basis points. But the impact could be even bigger. When interest rates go up, the value of bonds, especially longer-term ones, goes down. According to calculations, if interest rates go up by 1%, the value of a 10-year Treasury bond could drop by almost 10%. If interest rates go up by 2%, bond prices could crash by at least 7 to 10%. This would be a big problem for big banks and even smaller regional banks. The timing of China selling its US bonds is a major concern due to the ongoing liquidity crisis in American banks. The US Treasury's actions have contributed to this crisis, and the Federal Reserve has established a program to assist banks in exchanging their devalued bonds for cash. It is concerning that banks can still receive the full value of their bonds regardless of their actual worth. Despite the regional banking collapse, banks are still struggling with a cash shortage and have borrowed over $101 billion from the Federal Reserve. The situation worsens as the US Treasury withdraws an additional $1 trillion, exacerbating the cash shortage. Janet Yellen's need to sell over $1 trillion worth of bonds adds further strain to the financial system. This cash shortage could lead to a 5% decline in bond prices, equivalent to a 37 basis points increase in interest rates for riskier bonds, as predicted by JP Morgan. While US government bonds are traditionally attractive, the lack of cash prevents banks from immediately purchasing them. Despite favorable interest rates, banks would have to wait for bond maturity to avoid losses, especially considering rising interest rates. To address the cash shortage, banks can deposit their funds in a Federal Reserve facility, earning 5% interest and ensuring immediate access to cash. This arrangement is crucial to prevent potential bank runs. Essentially, the Federal Reserve has trapped itself in a cash shortage dilemma. Imagine a scenario where both China and the US decide to sell $1 trillion worth of bonds simultaneously. This would flood the market, leading to increased interest rates and a potential banking crisis. Such a bond sell-off could push the US into a recession and disrupt China's recovery as well. While this scenario is not likely, the trend of global dollarization poses a significant threat. Congress must address this trend as it undermines the US dollar's role in sanctions and other purposes. China selling LNG in yuan, Saudi Arabia considering diversification from the dollar, and Egypt planning to abandon the dollar and trade with BRICS countries indicate a significant threat to the US. Janet Yellen warns of the dollar's decline as the world's reserve currency and urges caution in severing ties with China to avoid economic disaster. The fragile US economy calls for normalized relations rather than provocation. If interest rates keep going up, especially because of a potential sale of Chinese treasuries, the US national debt will become even more unmanageable. This could lead to another debt ceiling crisis in 2025, and the only option left would be to lower interest rates, which could cause inflation to increase. With that said, thank you for watching. Be sure to hit that subscribe button and stay tuned for more. And if you found this content helpful, give the video a like. See you in the next video. Till then, take care.